Hey there, Teresa Timms, president of TDR Mortgage, and you can find me on the web at thesocalloanpro.com. So I want to share my screen with you. So I'm trying to find this particular document. Let me pull it up here. I want to compare and contrast programs for those of you looking for jumbo financing alternatives in San Bernardino and Riverside counties. Rancho, Upland, Corona, those areas are all on the eastern side of LA and Orange County. And oftentimes we find borrowers that are looking to purchase, but they just don't have the 15 or 20% down that jumbo financing usually requires. And what happens is in the San Bernardino and Riverside County area, we have a loan limit of 487,350. Is that what it is? 484,350. I know it's up there somewhere. Anyway, when we go over that actual loan amount, you go into jumbo, and jumbo requires 15 to 20% down. Now there are some, tricky alternatives that you can do, an 80-10-10, 80-15-5. There's a lot of different things that you can do, but it's not the traditional conforming type of product with the low rates and the normal type of traditional financing. So you have to get alternative types of financing. When it comes to LA County has high balance loan. So there's regular conforming, then there's high balance, and then there's jumbo. So in LA County, you get a little bit of a breather. So I'm going to show you, I'm going to compare and contrast a 750 purchase in San Bernardino County versus LA County. So let's start in San Bernardino County. So can I make this a little bit bigger? How do I make it bigger? I thought I could down here. But let me hide this right here. Okay, here we go. All right. So you can see my sales price is $750. The taxes and insurance portion are about 10 grand, and your closing costs are about 18,000, 19,000. It's not a cheap loan, but you are able to purchase 5% down San Bernardino County. So keep that in mind while we're going through this. This scenario is based off someone that has like a 680 to 700 FICO, 680 to 699 to be exact. The rate can be a little bit lower, and these 5% programs work ideal for people with 760 and above. Like we've got a gal right now, we're doing her 5% down at 5.25. So it's a really, really nice program. So when you're doing these 5% programs, you're better served by really delving into your credit. And we can help you, point you in the right direction for that. A lot of people just kind of don't think that it's really that or everybody knows that credit's important, but in these 5% jumbo alternative programs, it's really important. But let's get back to this compare and contrasting. So interest rate, 6.5%, 30-year fixed, no MI. 1.5 points, you're going to pay a processing fee, you're going to pay an underwriting fee, appraisal fee, and all these miscellaneous charges, loan-related charges. This loan actually has the taxes and insurance in it. So when we come down here, the tax insurance portion is $9,500 and the closing costs are $18,000. You need $65,000 cash to close, and your payment is $54,000. Now, one of the things about the payment, I want you to keep this in mind. You're putting 5% down. In mortgages, usually you can only not have monthly mortgage insurance if you put 20% down. So yeah, it's a high rate, but on the flip side, there's no mortgage insurance. Okay. This is jumbo alternative financing in San Bernardino County. These jumbo 5% loans, you need to have reserves. You need to have the debt ratios are a little more strict. So these are really done on a case-by-case basis. Okay, so there's that one. Are you ready for the next one? Okay, so now this is your purchasing in. No, that's the same one. Okay, here we go. This is your purchasing in LA County or Orange County. So let's see, let me make this bigger. Okay, so this is FHA. I picked FHA because FHA has a really great Debt ratio, we can oftentimes go up to a 56 back end. Sometimes in these high balances, you're limited to like 49.9. They're a little bit more restrictive. So what's going on here in this FHA loan and this interest rate? There's no fee. There's no hit for that rate. So when you come down here and you look, you have your taxes are $9,000 and taxes, insurance, and your closing costs are only $5,700. That's a breath of fresh air. So obviously you can see that this loan is superior to the other 5% down product. So you have your appraisal fee. Now you also have something called upfront mortgage insurance, which gets added on to your loan balance. So keep that in mind. We're going to look at it when we go down here a little bit more. Okay, so all this other stuff is exactly the same. Most of this stuff down here is all the legal third-party fees, title, escrow, things that you only pay one time. And then those are like your charges right here. And then you have your tax and insurance. Those are recurring. So those happen, those are recurring costs. And so when you look at them down here, when we look at like what are the true closing costs, this to me is like the cost of the credit. And right here, the tax and insurance portion, a lot of this factors into the APR. APR is largely unregulated. So whenever you're looking at how much something costs, please don't pay any attention to this prepaid or tax and insurance. That's a big misstep when people are calculating, comparing, and contrasting. Look at the closing cost, specifically the lender fees. When you're purchasing a home, you're going to pay an appraisal fee. It doesn't matter what lender you go with. You're going to pay a credit fee. This reinspection fee, sometimes on FHA loans, are a little bit more strict on the property condition. So the appraiser might have to go back out there to make sure the water heater is strapped. You have a processing fee. So this processing fee, that's a lender fee. That's purely a lender fee. And then another lender fee would be an underwriting fee. So those fees are pure lender fees. All the rest of the stuff is stuff that you're going to pay anyway, and you don't have control over. When you're purchasing a property, this escrow fee, you don't pick the escrow company, the seller does. So this fee right here, if I put $1,700 and someone else put $1,300, it doesn't matter. I'm actually estimating correctly, and the person that puts $1,300, when you get into escrow, you're going to find that they underestimated the cost of the escrow. So the escrow and title and recording fees, those are going to be what they are. So, there's a trick out there that a lot of these internet lenders do is they make those fees very, very light. And so there's a perception to the consumer that their fees are better when really you're going to pay those no matter what. So processing fee, lender fee. Processing fee, lender fee. Those are the two things that you're going to be looking at, and the cost to the rate. If there's a cost or points to the rate. So those three things are the most important thing. Okay, so obviously this is a better product. Look at your payment. It's $5,000. But now look what you have. You have monthly mortgage insurance, and you have this $13,000 upfront fee. So let's just kind of go back to the other thing real fast. Let's see, where'd it go? Okay, so let's go back, and is this really as bad as what you think? Okay, look at the payment. Payment's $5,400. So it's really not that much more than the other payment, is it? Now look at the money. You need $65,000. So you do need more money up front. So this $18,000, there's no $13,000 in here. So the FHA lets you finance that upfront mortgage insurance, but you better believe you are adding it to the loan. So when you really take a hard look at these two programs or products, just this upfront money factor is really the big thing. And then conventional, I don't have a conventional one on here, but conventional is largely the same as the FHA, except it doesn't have the monthly mortgage insurance. So anyway, let me go back here. Let's kind of revisit this just one more time, right? So, but I can tell you that a 4.3 rate is way sexier than a 6.5% rate. I totally get it. $13,000 funding fee that you pay in this FHA loan. So if you take $13,000 plus $5,000, really the closing costs are like almost the same, aren't they? I mean, when you really think about it, the closing costs are almost the same. It's just the payment's a little bit less with this. And then obviously you need the other one. You need 60. So you need $25,000 less with this thing. But look at your loan amount, 737. Let's go back and look at this loan amount. Isn't this fun? It's exciting to compare and contrast loans. Okay. Earlier when I was doing it, I wasn't really kind of paying attention to that FHA upfront funding fee. Oh, look at this. So your loan amount 712 here. Okay, 712. Let's go back. 712. Where'd it go? What happened? Did I get a bunch of new emails? Okay, 712. Go to our FHA. Our loan amount 737. What is that? 737. 712 minus 737. That's $25,000 difference. So these loans are actually almost identical. So I can make an argument for either one. So it really just kind of depends on your credit situation and what you got going on. And this is just one example. You know, being a mortgage broker, I'm able to shop different lenders. And we do have a lender where if your FICO scores are superior, we can place you in a little bit better product. So I'm really proud to present this as an option in jumbo alternative financing in San Bernardino and Riverside County. And if you'd like a custom consult and you'd like to purchase your dream home, then you need to pick up that phone and give me a call at 909-920-3500. Bye. Okay, stop.